the market collapse, stock market collapse that I would expect in association with a severe recession has not happened yet. This is just going to play out. It'll get worse as the year goes on. So you have what's called cost push inflation. That's where supplies choked off, or there's an embargo, or there's a shortage, natural disaster, a lot of things. It's coming from the supply side, and demand is inelastic, so you just pay up, or kind of do without. But the demand side is much more psychological. That's called demand pull inflation. That's when consumers behave the way I described. And as I say, I lived through the 70s, where, hey, I better buy it today, I better buy it now. You're pulling all this demand forward and bidding up prices because you're worried that it's going to get even worse. So as that applies to today, we are starting with the cost push inflation, mainly the price of energy, but the price of food is a big factor. And of course, they're related. It's like, here's the energy, here's the food. Where do you think the food comes from? To get the food, you got to feed the pigs and cows. What do you feed them? You feed them corn. How do you get corn? Well, you grow it on a farm. You need nitrogen fertilizer. You need diesel in your tractors. You get the food. You got to put it in a truck to get it from point A to point B. That requires diesel. The higher the diesel price, the higher the cost of food, because you're moving it by truck, etc. So these things, as I say, are linked. But food prices are going up substantially, and the two things you can't do without are gas in the car and food. So you have that cost push inflation. We're not quite at the stage where it's demand pull. We're not quite at the stage where individual consumers are behaving the way I described in the 1970s, saying, "Hey, better spend the money fast because it's losing value," and you see that in inflationary expectations and inverted yield curves. And I'll come back to that because that's a really big deal. If you thought inflation was going to run away, as it did in the 70s, yield curves would be steeply sloping, and people would be in a frenzy to buy stuff. They're not, and the yield curves are not sloping, or upward sloping. They're inverted. They're going down. That tells you that, and we also see this in inflationary expectations. Inflationary expectations don't drive inflation here and now. But what does is inflation here, and inflation here and now can feed on itself. Inflationary expectations don't drive it, but they tell you a lot. They're information rich. They tell you a lot about what people expect. What the yield curve is telling us, what inflationary expectations are telling us, and other factors are telling us, is that, there's inflation now, but the Fed's going to kill it, and they're going to kill it by destroying demand and throwing us into a recession. And here's where it gets interesting, because you could flip from this kind of inflation to disinflation or even deflation very quickly. And people are definitely not prepared for that. Well, I'm sorry, I shouldn't say that. Kind of everyday consumers are prepared for it. I'm not sure Wall Street and mainstream economists and policymakers are prepared for it. They're just extrapolating the inflation, saying, well, the Fed's going to kill it. Yeah, they might kill it, but at a price, at a very steep price, and consumers are really bracing for that. So, even Jay Powell said the soft landing is a myth. There's not going to be a soft landing. It's going to be a hard landing, but that's not priced into markets. The markets are kind of pricing in a squishy landing or a soft landing or from the runways. They're not pricing in a really hard landing, and that is what we're going to get. And it's important to understand there's a difference between a financial crisis and a recession. They're both bad, but they're two different things. 1998 was a severe financial crisis, but there was no recession. The NASDAQ hit an all-time high on January 1st, 2000. It went on for another year and a half, and there was no recession. 1990, 91 was an example of a recession, but no financial crisis. Some losses in commercial real estate, but there was no financial panic. 2008 was both. 2020 was a severe economic contraction. It's technically a recession, but it's kind of hard to know what it was. It's like, Anthony Fauci shut down the U.S. economy. So what is that? GDP fell 32% in one quarter. Technically, 2 quarters. Technically, it was 2 quarters, but it was really 2 months, March and April 2020. But March happened to be in the first quarter, April was in the second quarter, so it took both quarters down. But that was really concentrated in about 2 months, and then it, kind of came roaring back. But I call it a severe recession, contraction. But there was no financial panic in 2020. The stock market went down 30%, but it doubled from there. So these things can come together, and we're almost certainly in a recession now. Recession will get worse. So that that's not priced into the markets, but you don't even have to guess. That's here. It's going to get worse. The question is, are we in for a financial panic? That's kind of what you were referring to, Brian. And the evidence is yes. The evidence is right in front of your face if you know where to look, but most people don't. It's a little bit technical. I can explain it in plain English, but the signs are there. More than a hand, like I said, these things, they're often presented technically because some expert wants to seem smart or whatever, but you can do it in plain English. So basically what we're talking about, the warning signal, and it's a bright red flashing light, is an inverted yield curve. So what does a normal yield curve look like? So the x-axis is time, and the y-axis is interest rate. So and Treasury market's a good example, but there are other markets. I'll get to one in a second. So what are the maturities of Treasury? Well, it's 30-day bill, 60-day bill, 90-day bill, 1-year bill, or 360-day bill, 2-year note, 5-year note, 7-year note, 10-year note, 30-year bond. So that's your x-axis. And interest rates they can be negative, but kind of 0 to whatever. A normal yield curve is upward sloping. The longer the maturity, the higher there. And that makes perfect sense. If I'm going to lend you money overnight, I might want a certain interest rate, but if I'm going to lend you money for 10 years, I might say, hey, Brian, you got to pay me a little more because, I'm taking more risk, et cetera. Perfectly normal upward sloping yield curve. And whether it's steep or flatter, okay, that's important if you're a trader, but upward sloping. But an inverted yield curve is downward sloping. An inverted yield curve says future interest rates are going to be lower than present interest rates. Well, why would that be? If I'm lending you money for a longer period of time and I want a risk premium and protect myself, why would I take a lower rate? The answer is because I think really bad things are going to happen. And I don't mean me personally. I mean, this is the institutional market. So, and we see this in the Treasury market. It flips around day to day, but right now you have an inversion in kind of 2 years to 5 years. So a 5-year note yield to maturity is lower than a 2-year note. And you see it in 7s to 10. So the 10-year note has a lower yield to maturity than the 7-year note. It's not that the whole curve's inverted, but it's in sections. It is. So at the short end of the curve, 30, 60, 90 days, 1 year, yeah, it goes up. Well, that's because the Fed controls that part of the curve. They already told us what they're doing. We know they're going to raise 75 basis points in July, at least 50 in September. We'll see what happens in November. And then they have another meeting in December. But there's no reason to think the Fed is not going to remain on this path of 50 to 75 basis point interest rate hikes for the remainder of the year, which is going to get interest rates of 4%. Now remember when they did this from 2015 to 2018, late December 2018, they went from 0 to 2.5.